Welcome to an in-depth exploration of dividend policy, a crucial aspect of corporate finance that impacts both investors and companies. In this video, we'll delve into the fundamentals of dividend policy, its types, factors influencing it, and its implications. Introduction. Dividend policy refers to the decisions and strategies that a company employs regarding the distribution of its profits to shareholders in the form of dividends. These policies are crucial in determining the financial health of a company and its attractiveness to investors. Narrator. There are several types of dividend policies employed by companies. Stable dividend policy. In this approach, companies aim to maintain a consistent dividend payout over time, regardless of fluctuations in earnings. Constant payout ratio policy. Here, a fixed percentage of earnings is distributed as dividends. This policy ensures that dividends grow in line with earnings. Residual dividend policy. Companies first fund all positive net present value (NPV) projects and then distribute the remaining earnings as dividends. Narrator. Several factors influence a company's dividend policy. Earnings stability. Companies with stable earnings are more likely to adopt a stable or growing dividend policy. Investment opportunities. If a company has lucrative investment opportunities that can generate higher returns, it may opt for a lower dividend payout to reinvest in these opportunities. Liquidity and cash flow. A company's liquidity position and cash flow influence its ability to pay dividends. Strong cash reserves support dividend payouts. Taxation. Tax laws and rates can impact dividend policies. In some cases, companies may choose to pay dividends in ways that minimize tax liabilities for shareholders. Narrator. Dividend policy decisions have significant implications. Shareholder expectations. Investors often have expectations about the consistency and growth of dividends. Meeting or exceeding these expectations can impact a company's stock price. Company valuation. Dividend policy can influence how investors and analysts value a company's stock. Companies with a history of consistent dividend payments may be perceived as less risky. Capital structure. Dividend payments affect a company's capital structure and financial leverage. High dividend payments may require external financing for growth initiatives. Stock price volatility. Dividend announcements, changes, or omissions can lead to fluctuations in a company's stock price. Narrator. In practice, companies often adapt their dividend policies to balance the interests of shareholders and the company's financial needs. This may involve varying dividend payments over time based on performance, economic conditions, and strategic goals. Conclusion. Dividend policy is a multifaceted aspect of corporate finance that requires careful consideration by company management and scrutiny by investors. Understanding the types of dividend policies, the factors influencing them, and their implications is essential for making informed investment decisions and for companies aiming to create shareholder value. As we conclude our exploration of dividend policy, remember that this dynamic aspect of corporate finance plays a vital role in shaping the financial landscape of companies and investors alike, impacting the allocation of profits and the path to sustainable growth.